So welcome, Tom. Tom, really nice to have you here. For those of you who don't know, I have been working with Tom for the last number of years. Tom is from Marquis Financial Services. Marquis Financial Services. He's a mortgage broker, a mortgage advisor, I should say. Actually, he's slightly
Mortgage
different, but
advisor, we
mortgage
prefer, Shiv, yeah.
advisor. Absolutely, because you do advise, and that's really, really important to know. And that's exactly why I've got you on this show, Tom, because there's so many questions right now about the market and about rates and about what's happening. And what I want from this conversation and what I want our listeners to hear is advice. And of course, I understand that you can't give generic advice. It's got to be individual. And we'll talk about like how that process works as well with you. In fact, like why don't we go into that straight away? It's really difficult when people ask you questions because you can't give generic advice. You can't get advice to everyone that's listening to this show. So how do you guys work that make sure that you're, sticking within the lines?
Shiva, I think that's a really good point because everybody's individual circumstance and everybody's direction is slightly different. Everybody's mortgage amounts are different, everybody's terms are different, and everybody's requirements and plan is different. And therefore, advice really does have to be on an individual basis and not generic. So in terms of the way in which we work, look, I think this is standard for any mortgage advisor, but we complete a full and thorough fact find with the client. We understand what their preferences are. We understand what they're looking for. And then we use our knowledge of the lender, so the lender's criteria, but as well about what market conditions are out there at present. We have an interpretation of what's happening in the market. Now, we always have to be very careful about making predictions in the market. And I think that from clients' point of views, I think it's much more important to actually focus on what their position is rather than what the market is doing, mainly because the market can change.
Important. That's really important because, we talk about you giving advice. You're a mortgage advisor, not just a broker. So you're a mortgage advisor. And obviously what the clients want is for you to tell them what's the right thing to do, what's going to help them to win, and that's really, really a difficult thing to do. So how do you?
But then, what are you trying to win against, though, Shiv? Are you trying to win against the market, or are you trying to win in your own personal situation? Because look, I think that it's not really possible to win against the market to a degree, and it also carries a huge amount of risk.
Why is it? Let's understand. Why is it not possible to win against the market? Tell me.
Well, because if you look at the pricing of banks, for instance, banks understand the market. They have CFOs, they have risk managers, they have all sorts of people which understand what influences are driving that market,
right?
And they price their products accordingly. So, I mean, take for instance, over the last 18 months, 2 years in the residential space and in the buy-to-let space, we have been rewarded for longevity within a product. You have been rewarded for a 5-year fixed product, whereas historically you were always penalized for a 5-year fixed product. So you always paid for longevity. Whereas at the moment, because we've got an inverted curve on the interest rate market, therefore the interest rates right now are higher than what they're foreseen to be in the future. Lenders are therefore pricing their longer term products cheaper than their shorter term products on the basis that the cost of funding is due to come down. So the pricing of the products is already or has already taken into account the fact that the market is due to change. So if you're trying to beat the market, what you're effectively doing is saying to a bank, well,
I'm cleverer than you are.
I think to a degree, I think the mortgage market is going to come down by more than that, or I think the mortgage market is going to come down by less than that, and therefore I'm quite happy to focus on that 5-year product. We talked about this when you gave me a scenario not long ago. And I think we talked about a difference between the two particular products at the time you mentioned was around about sort of 0.6% or something like that. And I said that, well, if you think about this for a second, if you think about that, if you take a 2-year deal, but let's forget any fees and things like that. If you take a 2-year deal and it's 0.6% more than a 5-year deal, then in effect, you've lost 1.2% over a 2-year basis.
Yeah.
And so therefore, in the 3 years following that 2-year deal,
you've got to make it back.
You've got to make it back. You can't just allow your 2-year deal to come down to that rate of the 5-year deal, because otherwise you've still lost 1.2%.
Yes, of course, yeah.
It needs to come down by more than that to be cost effective. So I always do a very quick calculation that says, okay, well, if I've lost 1.2% over 2 years, I've got 1.2% to make up over 3 years. So that's 0.4%. if a rate was 4.6 on that 5-year deal that I was offered, my 2-year deal in the future has to be 4.2% or beneath. And
Right.
what you will generally tend to find is when we're running that calculation, we stop and we go, that's bang on current forecast.
Yeah.
Bang on
Yeah.
current forecast. And therefore the
Of
banks have
course.
already got on top of it to a degree.
So what you're basically saying, because I just want to distill, you've said something really important. I want to put it into like really basic terms. What you're saying is the banks have got loads of very, very clever people that they hire to work this out and to make sure that they don't lose money. Whether they do a 2-year or a 5-year, they're going to make the same amount of money because they've got the same profit hurdle that they need to get over. So based on current forecasts, as it stands today, the rates that they're giving you are really not going to make a huge difference to you whether you go for a 2-year or a 5-year, because from their perspective, they're going to make the same profit either way.
Well, they have their teams and their risk managers and their pricing strategies and the CFOs, etc., to work out what their rates need to look like over the next 2 to 5 years and onwards. And that's on the basis of a number of different things. That's on the basis of what the cost of funding is during that time. That's on the basis of what level of market share they're looking for. That's on the basis of what their competitors are doing. And it depends on what their service levels are as well. I mean, it was incredible during COVID, what we saw, particularly when banks had to suddenly close their service centres and relocate people to work from home. The logistical challenges of that was huge. And therefore, they couldn't accept an influx of business. So we all of a sudden had a fight between the banks to be not the cheapest, to be the more expensive. And therefore, rates increased during COVID, or the initial part of COVID, even though the cost of funding in the market was incredibly low, with base rate being 0.1% at the time. Then what we saw as the logistical challenges got or were overcame by the banks, that all of a sudden banks wanted to then start lending money. And we saw an incredible purchase market prompted up by the stamp duty cut, etc., and things, and what we called pent up demand at the time. So we then saw interest rates being cut and cut and cut and cut. So you'd probably see quite a big differential between the sort of beginning of COVID and the end of COVID in terms of what those rates were. I think that would be quite a big differential between the rates. Now, there was no difference in the cost of funding during that time. The difference was appetite to banks and what they actually wanted. So there are the pricing for banks is not just based on what the cost of funding is. It's based upon a variety of different things, including the market size, you know, what level of market they want to try and achieve, what their direction is, their service levels, their staffing levels,
and this could also make a
the
difference to when let's say, for example, you go to apply for a mortgage for whatever reason, this property is slightly quirky and the lender says, I don't want to lend on that. It may not be that they don't want, like the property can be fine, maybe another lender wants to lend on that, but because their appetite isn't there, you're saying that they might be saying no just because their appetite's not there rather than because the property's bad.
Yeah, that is the case. I think you find that your non-standard property types, quite similar to your small blips on credit file kind of profile
non-standard client types as well.
Yeah, exactly. They fall more into a niche market. And so, well, the way in which we word this, or the way in which I always look at this, is that the mainstream banks, you know, your top 6 and 7 banks, etc., they are looking for your vanilla clients, your nice clients that they know from risk profiles have a very, very low chance of repossession, very low chance of arrears and all the rest of it. So they will focus on your standard properties, you're employed or self-employed, but under standard kind of calculations, etc. Nice clean credit history, no more than a status 2 in the last 12 months in any credit file, things like that.
You're a 2.4 children kind of person.
And then you look at the niche lenders look at what the banks don't do, because niche lenders cannot compete in price in the banks. They can't compete. Banks will just squeeze their margin, or the main banks anyway will just squeeze their margin to zero, so that the other people don't get no money, get no business. So because the niche lenders,
because they're so big and they can.
They have so much capital adequacy, so much so big, etc., etc. We saw,
of course, because they have capital from the likes of you and me. Like my money's in the bank, deposits, and it's of course they have so much capital,
and the lenders such as HSBC, Santander, you know, the big banks nationwide and things like that. Although nationwide are a building society, but you know,
Yeah.
one of the big lenders, they will lend the majority of the deposit money in terms of when they're lending from their books. They don't
Yeah.
tend to particularly buy from money markets, whereas your niche and funding-based lenders, they will tend to buy from the sort of money markets. So the swap rates particularly important to those sort of lenders, and investor rates and things like that. Now, those sort of lenders look for areas where the banks don't lend. So this is particularly where you come into sort of, limited company buy-to-let as a prime example. Non-standard properties. I've got a CCJ that was 2 years old, but I've been good since then, kind of thing. Okay, well, we'll lend to you. You've shown a good track record, but the banks aren't particularly interested for another few years, etc. So they fill the gaps where the banks don't lend, but they price accordingly. So they're obviously more expensive than the banks. They need to make their margin.
But not a huge amount more. And I think the other important thing that I realized, some people are like, oh, it's, like 5% versus 5.5% or something like that, or 5.3%. Well, actually, I did this calculation this morning. 5% versus 5.5%. On the types of properties that we buy, that's £500 a year more expensive.
So we're talking of 100 grand lending, really.
Yeah. Oh, yeah. 112,500. But what point is, like, when you think about it in your mind, you're like, it's not like, of course, it's 500 quid, but you're like, it's 500 quid. Like, let's be clear about this. And that's why when you talk about like predicting the markets and getting it right and getting it wrong, maybe sometimes we go, it's not that big a deal getting it right and getting it wrong. Like, obviously, if you had managed to secure your amazing rate just before the pandemic happened, then you would have been really fantastically well off. But at some point, you're going to have to refinance. And at some point, you're going to get caught out again, aren't you?
Sure, I agree with you, but at the same point, my role is to make people's mortgages as cost effective for them as they possibly can. So when I'm looking at mortgages, even though it's £500, it's a standard wording, isn't it? It's better in your pocket than the bank's pocket. And so we do look at certain things, but there are, a number of different factors. When my experience when speaking to clients sometimes suggests that, okay, we've got this deal through this building society, or we've got this deal through HSBC, this building society is £200 cheaper over a 2-year basis. And people will quite commonly go, I'd prefer my mortgage with HSBC or Santander or Nationwide or one of these banks, etc., rather than a small building society that we don't know. We also know in our experience that the process for certain banks is much more fluid and much more quick and efficient, automated, yes, than some of the smaller lenders, etc. Smaller lenders generally tend to have a more manual process in terms of underwriting and things like that than the big banks do. So one thing can go through very quickly with one bank, one thing can go through quite slowly with a different lender, etc. And for me, I think that lending is financial, but at the same time, it's also based upon on other aspects. So, if we've got a client, for instance, that might be looking at taking further borrowing in the future, or looking at, consent to lets in the future, things like that, then lender choice is really key. And sometimes it's not just about what the cheapest deal on the sourcing table is. This is where
your fact find comes in, isn't it?
Well, it's fact finding. It's also generic knowledge and more specialist as well, I would say. I think we've had this conversation before, and I've been a mortgage advisor. We set the company up in 2007, and I remember during COVID times, and saying to clients when we looked at the pricing strategies of lenders, and lenders were all of a sudden coming in at much higher rates than the cost of funding would represent and things like that. And we were working out, and we were speaking to them, and they said, look at service levels and things. And we started to learn a lot more at that time about the pricing strategies.
Okay.
And then we get to November 2022, December 2022, and inflation started to come up. And then it obviously went skyward from there. And we start to realize even more about the pricing strategies from the banks and how different things are looking, and their appetite and their nervousness as well. There was periods last year where you could quite clearly see banks didn't know what was going on and didn't want to lend.
Because they were pulling their rates, weren't they? I remember there was a couple of periods where we were like, oh, we need to apply by tonight, otherwise the rate's going.
All the time. And we'll talk about that in a second, actually, because it's quite important when we think about the market. But I think that mortgage advisors, to a degree, have had it relatively easy for a long period of time in the run up from 2008 to probably 2020, because in effect the market was relatively flat. We did see variations of interest rates. We saw the funding for lending scheme brought out, which reduced interest rates. We saw base rate fluctuate from 0.1 to 0.75 at times, but generally that mortgage market was pretty flat. and I've said it to people before, I've learned more about mortgages in the last 3 years than I knew for the 17 before that. And I think nowadays mortgage advisors have the opportunity to further their knowledge, further their development, start having a look at what UK swap rates are doing, start having a look at what inflation is doing, start having a look at a variety of different things that are going to impact the mortgage market. Yes, we can't predict it. We have to be very careful about predicting it because, quite frankly, we all get it wrong.
Yeah.
We only have to look at the beginning of 2023, where every single economic report that you looked at would indicate the base rate stopped at 4.25%. Then we got data through in February, March, April, and May, which suggested that inflation was being much stickier in this country than it was elsewhere, and base rate and it was talking about base rate at this point going north of 6%, 5.75%, 6% and onwards. And then we get some good data out in September. All of a sudden, base rate is frozen at 5.25%. And now we've seen 2-3 months of relatively good data. And now the market's predicting certain benefits next year. But the market has changed dramatically in the space of 12 months, dramatically. And that wasn't foreseen particularly by economists. If you read the majority of papers, like I say, it was foreseen to stop around about there. And that's economists trained and having all the data at this point. So we have to be very careful about predicting the market. In my opinion, we can't predict the market. What we can do is we can have a look at the data behind the market, and we can have a look at what lenders are doing and what their appetite is, and what the way in which the sort of sector is looking at the moment, for instance. And we can use that to talk to the client, and then the client can make, to a degree, an informed choice on whether they're looking to make that gamble on the market or not. A prime example of that is at the moment, if you look at swap data at the moment, you'll see that 2-year swap data as of today is down at sort of 4.3%. Base rates at 5.25%. So what that's telling us is that traders in the market are estimating there's going to be a number of base rate reductions next year. We've heard 4. Today I read a report that said there might be 5. I think that's optimistic. The Bank of England have come out yesterday and the day before that, and various people from the Bank of England are coming out, and they're saying that interest rates need to be held high for longer. So the Bank of England and the market are at loggerheads at the moment, to a degree. The Bank of England is saying no, interest rates need to remain high at longer. We need to see sustained easing of wage increases before we even look at reducing rates. The last committee meeting by the Bank of England, we had 3 people vote for rate increases, and rate reductions were not discussed. And yet the market is saying, no, rates are coming down, rates are coming down, rates are coming down, rates are coming down. And
I suppose this is all the expectations piece as well, though, isn't it? Because obviously, you're saying, why is that? And it's because sometimes the Bank of England has to say something so that people, if they said it's going to be reducing, then everyone's going to price in ridiculous reductions. Whereas if they say, no, it's going to be high, then the reductions are going to be much more measured, perhaps.
I think we have to be a little bit careful, but I do see that Bank of England are able to influence markets by their statements and their words and being and in that respect, and maybe there is a little bit about that going on, maybe there isn't, I don't know. But I also believe that the Bank of England has to work in coordination with other central banks as well. And it's a very complex market in terms of reducing and increasing and changing rates dynamics, etc., and things like that.
Talking about being a complex market, so I get this question probably about once a week. Why should we bother using your mortgage broker? Because I've got a mate down the road that can do it for me, or I can look online myself or whatever. Like what? So help us understand, Tom, because you're now saying that because you've learned so much over the last 3 years, and of course you've been doing this for a number of years now, you're in a better position to advise. But why do people need mortgage advisors rather than going to HSBC, their bank?
It's a great question. Look, in my opinion, and I'm going to say this as a mortgage advisor, but I truly believe this, your mortgage, whether you have 1 mortgage or whether you have 30 mortgages, is your biggest financial commitment. So it is important to make the most out of that mortgage and get the best advice. And as we've already suggested during this call, it's not always just about rate. All right. There is quite often a time when we look at the sourcing table for a client and we see a mortgage lender at the top of the rate and at the top of the rate table, and then they advise me of something that they're looking to do in the future, or they advise me of something that they've got in their own personal circumstances, and we go, well, actually, that mortgage lender isn't suitable. That mortgage lender is suitable. Now, look, if every single mortgage lender had exactly the same criteria and exactly the same rules, then granted, all you're paying me for, or all you're using a mortgage advisor for, is to make my job easier. All right.
Yeah.
And it is much, I mean, my experience tells me it's much easier to deal with somebody like ourselves who has your best interest at heart, who treats you like an individual, than it is to deal directly with a bank, especially in terms of the fact that, we've been doing this for a number of years, etc., and things like that. But if everybody had the same criteria, everybody had the same rules, everybody had the same, internal procedures and things like that, then granted, to a degree, it's just a rate table. But I don't think it is just a rate table.
And when you say it's more than a rate table, help us understand what it is. Because in my head, I'm thinking to myself, there might be, I am able to tell you a whole bunch of information. Here's all the information. And you are able to then present it to the bank in a particular way that makes them accept the case, rather than just kind of going, here's all the information.
Well, yeah, there's been examples of that. I mean, I've had clients that have come to me before and said that I've applied to my bank for a mortgage and my bank has declined it. And I've said, why? And they said, well, I don't know. They just declined it. And I've looked at the criteria. I've looked at the way in which they've said it to me. And I've said, well, there's no reason at all for the bank to decline it. And I've gone to that same bank 2 weeks later and the mortgage has been approved in 2 weeks. So there are the way you package a mortgage is important, and, presenting it to the bank in the correct way. But that being said, this is more about different lenders' criteria and how lenders assess. Okay. So if, for instance, if we take some examples and if we take Coventry Building Society as an example, who use latest year's profit for self-employed in a net profit scenario, and we compare that to Halifax, who use an average of SA 302 information over a 2-year, the difference between what that bank will lend and what that bank will lend could be huge. Right. So you can go to your bank and you can say, I've got this as a salary and dividend figure for the last 2 years, and the bank will spit out an answer and say, right, we'll lend you this. That could be nowhere near what you want, and you could just go, I'm not going to get the mortgage that I want. Where being a different way of assessing that income and a different way of assessing that client could be, could get you exactly the mortgage that you want. Then you've got the early repayment charges, different structures for different banks, different rules in relation to consent to lets, like we said before, different processing times, different valuation times, all that sort of stuff in relation to banks. So there are big differences. If we look at it in relation to the buy-to-let market for a second as well, and we look at how different mortgage lenders assess the buy-to-let market. Some mortgage lenders have minimum income. Some lenders have no minimum income. Some lenders want portfolio landlords. Some lenders don't want portfolio landlords. Some mortgage lenders have a stress testing of pay rates on buy-to-lets. So buy-to-lets are quite often assessed on the rental income for the property, and they have stress testing on it, etc., which we'll come on to a different discussion about that shortly, I'm sure. But one mortgage lender will give you 75% of a buy-to-let because of the stress testing. Another mortgage lender might give you 40% because of their stress testing. So,
what you're saying is that because you work with these lenders day in, day out, you know a lot of information about all of them. And so not only can you package it in the right way, the information that I give you, but you can help me to choose the right lender based on what I've told you I want to do. And because it's not always as simple as like, I want to have a buy-to-let property and I'm going to keep it for 20 years. It might be, I want to do that, but in 3 years time, my son's getting married or something. I want some money for that. Or, the whole point of this is to pass it down to my family, or the whole point of this is to draw income from it so that I can use it myself. Or all of that kind of information you take in and you say, based on the information you've given me, I can now, because I know all the lenders in the market and I know what their criteria is, I can pick the right one for you. Is that kind of what it is?
And we also have the tools, Shiv. So, we've got all the different lenders calculators. We've got some generic calculators, which spread it between a number of different mortgage lenders, etc.
You also have, I believe, because I remember we did this very recently, you have direct contact with the, I don't know, business development manager, or whatever you call it, the bank.
Key account managers.
We had one that we were doing just now, which was I'll tell the audience, we were buying a property, and Tom was doing the mortgage for it, and we were trying to figure out like how are we going to get this one through, because there was a couple of nuances to it. And I said, we need to know before we buy it that we can actually get the mortgage, because we were actually going to buy it in cash and then do some works to it. And so what Tom was able to do, Tom, do you want to explain what you did there?
Yeah, so this was a multi-unit freehold. So if I'm right in thinking we're talking about the same property, it's a multi-unit freehold. So it's a property that's split into two flats under one freehold. There was a couple, like you say, there was a couple of nuances towards it. So what we were able to do actually is take your research for the property, which included photos, it included the property address, it included what you were planning to do. Yeah, the schedule of works, what you were planning on doing to the property. And we actually sent it direct to the lender, who then sent it direct to their valuer. So even before we actually applied for the mortgage, they have an internal valuer in the system that's in their underwriting department that had a look at that case and said, yes, on the basis of this, we are happy to go to evaluation and accept this application.
And you came back to me within, I think it was less than 48 hours. It was less than 2 days, definitely, but I'm pretty sure it was within a day. And I'm just thinking, if I was trying to, call the bank myself, I mean, I'd be on hold for 2 days for a start.
I think so, mate. Yeah, I think so.
But okay, so that makes sense. That's why there's some value in it.
The market is heavily leaned towards intermediaries and mortgage advisors, and therefore, from a bank's point of view, their distribution to mortgages is more focused on that intermediary market. So we've not even talked about exclusive deals, for instance. If a bank wants to get certain lending out and wants to hit a certain figure in terms of lending for a period of time, or even if they want to just attract some good PR, they will quite often do it directly through an intermediary channel rather than a direct market, because they know that if they know that the intermediary market they'll get that business quite quickly.
So what you're saying is, for example, there could be potentially a discounted rate that you are offered that we can't get on the open market.
Yeah. I mean, it does work both ways. That every now and then, particularly in a restricted market, you do sometimes see banks offering some online exclusives. To the direct market. It was happening quite a lot in 2007, 2008. Nowadays, it happens a lot less, and generally, you tend to find the exclusives are through the intermediary market.
Yeah, and then just going back to, I know, look, you caveated before, like, we can't read the future and all that kind of stuff, and you offer advice based on people's personal circumstances, and you don't try to read too much into, or at least you don't try and say too much about what's going to happen in the future. But Tom, I'm going to break your golden rule. So we're now, end of 2023, coming into 2024. It's a very exciting time in the property market. And the fact of the matter is that what everybody wants to know, especially from someone like you, and the reason why I like talking to you is because you've really got your head screwed on when it comes to the economics of it. And I think sometimes, and as you're going to say what you're going to say now, I want you to, in a nice way, audience listening to this, dumb it down a little bit, because we all want to understand it. And sometimes what you say, you're saying it so fast and it goes over people's heads. Let's go down to it. The question is, what's going to happen in the property market? And explain to me about the rates, and explain to me about the prices of property. Those are the two kind of things that people will ultimately want to know about.
There is a lot of data in the market to suggest that next year we've got a restricted mortgage market.
What does that mean?
It means that the level of lending in the mortgage market next year will be down. So the height of the mortgage market was at roughly 300 and something billion. It was a lot less last year, and it's going to be less again next year. And gross lending is forecasted also to be down. I mean, these are forecasts. In terms of house price, in terms of movements on that, I think that what you'll generally tend to see is that as interest rates do reduce, it will increase activity in the mortgage market, and it will increase activity in the purchase market. We've said this to clients over the last couple of years, particularly when they've been looking at buying, and we've had questions such as, is it a good time to buy? And my response to that is, particularly in a residential space, it's never a bad time to buy, because although you've got higher interest costs and mortgage costs at the moment, that's reducing demand on property. If you have lower interest rate costs and lower mortgage costs, it will increase demand on property, and therefore you'll end up paying higher, but put more for the property price.
Right.
I think that this.
Sorry, so that's a really important. That's a really important point. Let's just recap that. What you're saying is, in the residential buy-to-let property market, in any residential market, you don't think there's a wrong time to buy, because what you're saying is that when the mortgage rates are high, there's less demand, and because there's less demand for it, the prices go down. So that's a good time to
Yes.
buy because you save money on the property price. And you said when the property prices are higher, the mortgage rates are lower. So you're saving money on the mortgage rates.
When mortgage rates are lower, it generally will increase demand on property.
And because of the increased demand, it means that property prices increase. So you can either buy it when the prices are lower, but you'll have to deal with the fact that the mortgage rate might be higher, or you can buy it when prices are higher, but the mortgage rates will be lower. And I think where we're coming into right now, you've mentioned already, is that we're on the cusp of the mortgage rates coming in a downward fashion, but the prices are negotiable, but are soon perhaps not going to be, or will be less so because the demand will increase.
I think we can't speculate particularly too much about what buyers will accept or what sellers will accept, sorry, in a property market moving forward. What we can say is that generically, as interest rates reduce, bearing in mind that there's been a lot of people over the last 18 months that haven't bought because interest rates have been high, haven't sold because they didn't feel they were going to get the value for the property, etc., and things like that. So I think naturally what we will see as interest rates reduce is that demand increases for property, and property is a supply and demand thing. So if demand increases for property, that would naturally mean that you would start to see increases in values rather than any decrease in values. And I think looking at the property market over the last 18 months, I think the property market has once again stunned everybody in the fact that it's held up an awful lot better than what people were suggesting it would do. There were reports to say that property prices could crash 20%, in these last 18 months, and I don't know the figures to hand, but they haven't crashed that to that level. It's performed much better than was expected. My opinion with property is very much that it's two area specific. We can look at nationwide averages and we can take it's gone down by 1%, 2%, 3%. Next year it's going to be down at 1% down or level depending on the market. I always think that property prices are so area specific that you can have property prices go down by 3% in one postcode and up 2% in a postcode next door. So I always kind of stay away a little bit about providing advice on too much house market movements. I know that the forecast that we recently heard was that property prices over the sort of next 12 months will be pretty stagnant.
And if that is, and again, that's what you're saying, is that's the average across the UK, and it will vary depending on the location. Specific.
But also again, what can change that? Interest rates. If interest rates reduce, let's say the traders are right. Let's say the traders are right, and the base rate gets hit, 3-4 times next year. The central banks would have to move as well, and things, and from what the Bank of England is saying, we'd have to see a wage price sort of inflation drop, causing that pressure. But let's say the traders are right, and you start to see number of base rate reductions next year. I believe that will be great news for estate agents and property owners. They will start to see property demand for property increase, and I'm not saying it will return to the COVID times where we had one property on the market and 20 people interested in it, and therefore it drove up properties over asking price and things. But an increase in the property market will generally mean that you'll have more chances of achieving your asking offers, and that property prices will start to perform better than they have done over the last 18 months.
Okay, cool. And one of the things that I got asked a question by a client the other day, it was last week actually, and the first thing I did was I called you because I had my opinion on it, but I wanted your opinion on it because there's a reason why I have my opinion on it. And the question was, he had been presented with two mortgage rates. One was a 2-year rate, one was a 5-year rate. I believe it was the same lender in each case. And obviously there was a difference in the rates. Outside of the difference in the rates, because there is a difference in the rates, the question is, do I go for a 2-year or do I go for a 5-year fix? And I say 2 and 5. We know that there was some 3 years previously, which kind of seem to have gone out of fashion. And there are also some, longer term fixes, 10 years, etc. But generally speaking, at the moment, the mortgage market seems to me at least, buy-to-let mortgage market seems to focus on 2-year and 5-year. So if we're looking at those two options, Tom, how can you help us understand how we should go about analyzing these rates and how we should ourselves go about making that decision of whether we should go for a 2-year or a 5-year fix?
Well, I think that if we look at the if we look at the concept of 2-year versus 5-year fix, I think the first thing to look at is what type of mortgage is it, and what does the client want? When does the client next want to review that mortgage? Does the client even want a fixed rate, for instance? How much does the client want to borrow? And there are a variety of different factors involved in making that decision. I think what we spoke about particularly was looking at the overall cost of that mortgage, because a mortgage isn't just about rate. It's about how much does that mortgage cost me over the particular deal period involved.
Yeah.
So, for instance, I mean, we spoke about, I think, well, I've looked this morning at a couple of the interest rates on the market.
Let's do some examples. Yeah.
And this is in a limited company buy-to-let space. And if you look at, and I've looked at a mortgage of £100,000 for ease. But if you currently see a 2-year fixed in the market leading rate at the moment, from what I could see, is 3.65%. And that 3.65% has a 7% fee.
Okay.
So a 7% fee.
That's a ridiculously low rate, it seems like. And of course, now we're going to work it out. Go on.
Well, yeah, but 7% fee. So 7% fee over a 2-year basis is effectively 3.5% per year.
Yeah.
So if we take 3.65 and we add
3.5,
3.5, I think, what do we get? 7.15%.
7.15, yeah.
So to me, that's your net rate. That's what you're paying over a 2-year basis for that product.
Okay.
Then in addition to that, have you got any valuation fees? Have you got any legal fees, etc.? How much are those going to cost? And if we monetize that and look at it as a percentage of it, I did this very, very quickly before, and I think you've got a net rate of about 7.325%.
So whilst it looks really, really attractive because it's 3-point-something%, when you actually look at it, it may not be as attractive.
Yeah, I compared that to another 2-year deal in the market, which was 5.19%.
Okay.
5.19% with a 3% fee, but it had a free valuation and a free legal service. So effectively, that's a 6.69% net rate. And lender quality as well was very good, etc. So if I was looking at that mortgage, I would probably be suggesting that 5.19% deal was a better option for the client. But then this is what, when we talk about the client specifically, the client may have a focus on saying, no, well, the most important thing for me is not my asset, it's not my the value of my equity or the value of my product, it's my monthly income. So my monthly income is going to be better on 3.65% and not the 5.19%. So therefore, that's the way I want to look at it. Another client may say, well, no, my income's subsidized elsewhere. I'm quite happy with that. I want to keep my equity position in the best position in the best way. And therefore, I might look for a product with no fee for them. Might start at that 6.69%. So I think that the first thing to look at when you're looking at a mortgage product is the overall cost, not just the interest rate itself, and take into account your valuation cost, your legal cost, your arrangement fee, and your interest rate, and what's more important to you. Yeah, I think that same calculation gets done on a 5-year deal. So if we look at the 5-year deals in the market at the moment, cheapest mortgage rate in the market currently is 4.45% with a 10% fee.
Wow. So
we're looking at that as a net rate. What is it? 6.45% over a 5-year deal. Then you've got an upfront fee of £930, which is effectively what, £1,000 over from £100,000 property, so 0.2% a year. So all of a sudden we're at a 6.65% net rate. Elsewhere in the market, we've got a 4.79% with a 5% fee. So for me, again, 5.79%.
Yeah.
No valuation, no legal costs, so flat 5.79%.
So where you're going at the moment is if you're trying to choose between, let's say, 2 or 3 2-year rates, then you can take the overall. And again, like with 5-year rates, you can take the overall. That's what you've said so far, isn't it?
Always look at the overall cost of borrowing, in my opinion. And then like I say, then you have to look at what's important to you. Is it the overall cost of borrowing, or is it the monthly payment concept? And then you can go down certain routes with that. But a very key point with it, and we'll discuss this, that, is how much you want to borrow. So, for instance, particularly in a purchase of a buy-to-let market, then because of the way that regulation is in the buy-to-let market, you have a lower stress testing of a product on a 5-year product than you do on a 2-year product. So, for example, mortgages where you're trying to borrow 75% loan to value, for instance, and the property is and the mortgage is based upon the rental income for the property. That mortgage amount that you want, £75,000 in a £100,000 property, on a 5-year fixed product is quite often stressed at the pay rate. So if the pay rate's 4.79%, then
what's the pay rate? Just explain that for us.
in this scenario, the pay rate is what your interest rate you're getting from the bank.
Yeah, okay.
So in the scenario we had before, that interest pay rate would be 4.79%. So you take that £75,000, you times it by 4.79%, and then limited company stress testing, quite often is around about 130%. So therefore, you get a rental income requirement for that property of £389. I think if you know that if you're looking at £100,000 property, you're looking at rental income of more than £389. So it kind of works for you on that 5-year deal.
May not in London.
No, maybe not in London. But if you look at it with the 2-year concept, for instance, right, £75,000, instead of it being a pay rate stress test, it's quite often a pay rate plus 2%.
Okay.
PREG regulation states that. So £75,000 at 5.19%, or sorry, pay rate plus 2%. So £75,000 times by 7.19% now, not 4.79, times by 130%, means that your rental income for that £100,000 property is now required at 584. Now that's probably getting a bit more tighter. £100,000 property for a single sort of AST basis or a single property. So therefore, it will also depend on how much you're looking to borrow will determine what product you're doing on this particular buy-to-let space. Then you have to look at what your plan is. We have had a lot of conversations with clients before, but again, in the limited company space, where we've said that for your purposes, if you're buying a limited company property, let's tie it up for 5 years. Because after 5 years, you've had chance to achieve rental profit. You've had chance to achieve capital growth. And then potentially let's look at that property then and see what your options are. Can we release any capital out of that property so that you can then go and buy your next property and so on? So it really does depend on the client in terms of what property, in terms of what products and what advice they receive.
Yeah, that was really, really good. I think it was very succinct. I've just written down some notes. First thing is you've got to consider the overall cost of it, including the fees. And that's quite an reasonably easy calculation to do. The second thing is that you've got to consider that a 2-year rate might have a higher stress test than a 5-year rate. And whilst that's not usually an issue for us, but in other parts of the country, that may well be a big issue where you cannot get that mortgage as a 2-year, but you can get it as a 5-year because the stress test is lower. The third thing I've got down is we've got to figure out what's important to us. Like you said, for some people, cash flow is really important because they're going to, for example, I don't know, quit their job and live on this income or something, whatever it might be. So cash flow is really important. For other people, it might just be actually, I just want to make the absolute, I don't know the best way of saying this, but the best return that I can overall over, the picture, over the period. And so for them, they'd be then looking not so much at the cash flow, but also
overall wealth. Other people will look at their equity position, their total equity position. If you're putting a 5% fee into their equity position, that equity position is lowering down. Yes, they could pay it up front, but the majority of people you'll find generally don't tend to pay an arrangement fee up front.
And then that final bit, sorry, go on.
I was going to say, I think it's important to just sort of look at these fees for a second in relation to limited company buy-to-let space and why they are there. And as well as it also mirrors the residential buy-to-let space as well, or the personal buy-to-let space, sorry. You see, when interest rates were 0.1% as a base rate and 0.5% as a base rate, banks used to stress test the mortgages at that point at 5.5% on 2-year lending. And on 5-year lending, it used to be sort of anywhere between 4 and 4.5% and things. And then your limited company space would do that generally around about 125% of stress testing. Now, as interest rates have increased so much over a very short period of time, and although rents have increased, they haven't increased at the same sort of level as percentages of mortgage rates. Banks have had to be creative. So if banks increase their interest rates to, over and above base rate, or created a margin between prime residential and buy-to-let and limited company buy-to-let, which is historic because of risk factors, then simply buy-to-let lending wouldn't be available. Because of the stress testing. So what banks have actually managed to do, and have been quite clever with it, is that they've kept their interest rates very low. So for instance, 4.45% is as low pretty much as you will get on a residential 5-year fixed at 60% loan to value. In fact, I think it's ever so slightly lower on a remortgage. So the buy-to-let limited company space is lower than the residential space in that same market. But it's because they put the fee on it. So they've increased their fees to allow them to lend. It's not, to a degree, greedy banks at all. It's
Okay.
being relatively creative in terms of actually making a market work for them and clients.
Sorry, and just to be clear, when you say it's not greedy banks, it's because you're saying they are somehow required to do these stress tests, like their
Yes.
regulation authority, whoever it is, required. Is it the FCA, FSA, whatever they're called?
I think it's it's PRA regulation, I think,
Okay. Yeah.
in
There's some
relation to the
regulation that the
buy-to-let.
government
Yeah,
has put into place to make sure that people aren't, doing silly things with their money. And as a result of that, the only way they can lend, otherwise they wouldn't lend. So the only way
yeah,
they can lend is by structuring these in a certain way, so then they'll be able to lend. And of course, they're not forcing you to take their mortgage. You have the option of taking their mortgage. They're effectively offering you and saying, here you go, do you want it? And if you want it, you can take it. If you don't want it, you don't have to take it.
yeah, definitely, definitely.
That's
They've
very useful
created
to know.
relatively clever, relatively or
Structures,
different
yeah.
ways of pricing the products so
Yeah.
that the rates are lower to allow them to lend more monies in the buy-to-let space, but they've increased the fees because of it in certain sectors. And what you will generally tend to find quite commonly with the buy-to-let sector is that you've got a lot of different options. You've
Hmm.
got your low rate with your high fee. You've got your medium rate with your medium fee. And you've got your higher rate with no fee. So you do have
Hmm.
those various options in that limited company buy-to-let space, as
And
well
would
as
you
the
say
personal
those
buy-to-let space.
those three that you said, so low rate, low fee, medium fee, high rate, high fee? I mean, a slight analogy to make things easier. I always say to people, this is potentially a bit, I don't know whether the mortgages market's like this, but sometimes you have a company called British Airways, and British Airways, they charge you 250 quid for the flight, whatever it might be. And with the 250 flight, there's no other fees to pay. You pay 250 quid, everything's included, happy days. And then there's Ryanair, and Ryanair charge you 25 quid for the flight, but then you got to charge 25 quid just to, check in your bag. You charge 25 quid to go to the toilet. You got to charge 25 quid for a glass of water on the plane. So, but obviously the point is it all adds up. And my thought process was that they both need to make 250 quid to make it work. They both have the same margin hurdle to achieve. And as a result, whether you want to look at it from the left-hand side of British Airways or the right-hand side of Ryanair, in the end, you're going to probably end up paying a similar amount. Now, I know it's a bit different in the air industry because you don't have to have the glass of water, you don't have to check in the bag and all that stuff. But in the mortgage market, is that kind of same sort of thing? When you say the high, medium, and low rates and the high, medium, and low fees, is it a case that they're all pretty much going to make the same money? So, of course, we need to be careful and mindful based on what we want. But from an actual overall wealth perspective, from an overall money perspective, like it's probably going to work out similar.
Similar, yeah. I mean, you tend to see that banks and funded lenders, particularly in limited company space, nobody will be way out front on their own. So
Yeah, yeah,
you wouldn't necessarily see a lender having a 1% reduction compared to everybody else in terms of overall cost.
yeah,
So they will be relatively creative in terms of how their products appear
yeah,
differently. And
yeah,
therefore, some will have a fee, some won't have a fee, some will have an upfront valuation fee, some will give a free valuation, some will have free legals, some won't have free legals. Less common in the buy-to-let space, but it's still there in some aspects. And so, yeah, they all
they
have
package them differently,
they package
but
them differently, and throughout the whole sourcing table, yes, there's a big difference in terms of the overall cost, but you will generally tend to find that the overall cost sort of increases marginally per lender, per lender, per
yeah,
lender. So all
yeah,
mortgage lenders are pricing within a framework of a market, and
yeah,
no lender really jumps out in
priced
front
by
massively for
themselves.
a period of time. Yeah.
Yeah, fantastic. Tom, that's been really, really insightful for us to try and understand about the mortgage market. Where is it going? And specifically, then, how does it impact the property market for next year, for 2024? Because I think a lot of people are going to be looking at how to make this work for them. Like you said, a lot of people who are probably going to be listening to this podcast may well have been sitting on the sidelines since before trust, kind of waiting, well, when's this all going to come down? When's it all going to settle? And then they are starting to realize now that actually, things are starting to settle. Maybe the mortgage market's the mortgage rates are going down a bit. The rental numbers are going up because there's a lack of supply in that market. And as a result, it might be a good time to get in now before kind of perhaps everyone else does. Who knows? That's where we've got to. It's been a really interesting conversation. Is there anything else that you think that I've missed on this in this podcast? What else should I?
No,
Is there anything else?
no, I think for me, I think property will always be a pivotal part of UK wealth, and I think that people will always, or people look towards property. They like the property. They know what a property is rather than, an index-linked fund or whatever it is. But they know what a property is. They know what it gives you, and therefore, property will always be an investment that the UK people want.
That's a good mind. And
In
actually,
terms,
you deal with a lot of high net worth individuals as well. People like, millionaires and stuff, people that have lots of money, and, they're investing in property as well. It's not like they're doing potentially something different.
No, a lot of them invest in property.
Exactly.
So everyone has different profiles. Some people with
Of
low
course.
incomes have have little contributions into an invested fund,
Yeah.
and millionaires have multiple, or sometimes have multiple properties. Everybody has their
Yeah.
own different dynamic of it. It depends on the person, etc., and things like that.
Yeah. Yeah.
Definitely.
Fantastic.
But no, I think that I think it's been a great conversation. I think what I was going to say is that, the property market, I think, will always be a market where people want to get involved in. It's a supply and demand commodity. Like we say, I think it was quite important to sort of talk before about the way in which, if interest rates do start coming down, you might see demand for property going up and things like that. And I personally truly believe in mortgage advice. I do think it's a requirement, if I'm being completely honest with people.
Yeah. There's no way that, the point is, the same as like a plumber, isn't it? You wouldn't, go, I'm going to go and do it myself, because if you do, you might screw it up. And even if you knew what you were doing, you might screw it up, and then you might screw up the whole system. And maybe that's the thing with mortgages. You could get it right, but you could also get it wrong.
I think it's quite a good analogy, isn't it? But a few years ago, etc., no one would even dream of doing their own plumbing. Now you can get a YouTube video on anything you want. I still wouldn't dream of doing my own plumbing. I still wouldn't do it just because I can see a video on how to do it. And so, for me, a mortgage is your biggest debt. It's very important, and you should take advice on it.
Fantastic. Tom, it's been really fantastic talking to you. And what we'll do is we'll link in your details into the show notes here. I think this will be really good, not as only just as a podcast, but we'll cut this up into loads of clips. I think we've got so many little great nuggets from you. It's been really, really fantastic. So thank you so much for your time.
Pleasure, Shiv. Look after yourself.
Cheers.
Take care.